Welcome to the recap of the PNJ Group series on the FASB Conceptual Framework. Over 8 sections, we moved from the purpose of financial reporting all the way to the controls that keep it honest. In the next 20 minutes, we will retrace that arc, connecting every piece so you can see the framework as one coherent system. Let's begin where the course began, with the question of why any of this exists. We will revisit the single objective of reporting and who it serves, the qualities that make information useful, and the 10 elements that are the building blocks. We will recall how items get recognized and measured, then watch the framework solve real problems. Finally, we will retrace how to research the rules, how IFRS differs, and the controls that hold it together. Let's start with the objective. The conceptual framework is the reasoning behind every U.S. GAAP standard, but it is not itself authoritative GAAP. When a standard is silent, a SC 105 sends you first to similar standards, then here. 3 concept statements matter in practice: SFAC 6 for elements, SFAC 8 for the objective and characteristics, and SFAC 5 for recognition and measurement. Understanding the why makes you apply the rules correctly. Everything serves one objective: providing financial information useful to those deciding whether to give the entity resources. The primary users are existing and potential investors, lenders, and other creditors, all trying to estimate the amount, timing, and uncertainty of future cash flows. Management, regulators, and tax authorities are not the primary focus, because they can demand information through other means. 2 quieter ideas shape the standards. Stewardship, restored in 2018, means reporting helps users judge whether management used entrusted resources well, not just whether cash rose. And the entity perspective, which U.S. GAAP adopts for consolidated reporting, means the statements represent the whole business regardless of who holds the claims. Both ideas justify disclosures that pure cash prediction would not. Useful information rests on 2 fundamentals. Relevance means the information is capable of making a difference through predictive value, confirmatory value, or both. Faithful representation means the depiction is complete, neutral, and free from error, all 3 at once. These are non-negotiable. No enhancing quality can rescue information that fails either fundamental, so we always satisfy these first. Materiality is relevance applied to one entity. It is both qualitative and quantitative, with no universal percentage, so a small error that hides a trend can still be material. Discuss immateriality with your manager before relying on it. Prudence, restored in 2018, means asymmetric caution, more care with gains than losses. It never licenses deliberately understating assets, which would violate neutrality. 4 enhancing characteristics sharpen useful information: comparability, verifiability, timeliness, and understandability. They improve information but can never substitute for the fundamentals. And the cost constraint sets a sensible limit. The benefit of information must justify its cost. But remember, that constraint limits what is required. It never excuses omitting information whose benefits clearly exceed its costs. SFAC 6 defines 10 elements. 3 describe position, assets, liabilities, and equity. 7 describe performance, revenues, expenses, gains, losses, comprehensive income, and the 2 owner transactions. Every entry you record is ultimately a movement among these 10. Comprehensive income is the widest performance lens, capturing net income plus other comprehensive income, changes net income alone would miss. An asset is a probable future benefit the entity controls from a past event. A liability is a probable future sacrifice from a present obligation, also from a past event, which is why a mere intention to buy something next year is not yet a liability. Equity is simply assets minus liabilities, the residual, which is why any error in assets or liabilities flows straight into it. Whether an inflow is revenue or a gain turns on one question: is the activity central or peripheral? A dealer selling a car earns revenue, a maker selling surplus equipment records a gain, and the distinction has consequences under a SC 606. And note, probable in the element definitions, is a lower bar than in contingency accounting. A doubtful receivable is still an asset. The uncertainty just affects measurement. Recognition formally captures an item, and it requires all four SFAC 5 criteria at once: definition, measurability, relevance, and faithful representation. Fail any one and the item is not recognized, even if it clearly exists. When an item fits the definition but cannot be measured reliably, you disclose it instead. But disclosure never substitutes for recognition when all four criteria are met. Derecognition removes items. Assets come off on loss of control, liabilities when discharged, canceled, or expired, and sometimes only a portion leaves through partial derecognition. Legal form does not control, economic substance does. And every one of these judgments rests on the unit of account, the decision about what you are even measuring. Set it before you measure anything. There is no single yardstick. U.S. GAAP uses 5 attributes: historical cost, current replacement cost, fair value, net realizable value, and present value of future cash flows. No one attribute applies everywhere. Each standard prescribes the right one. Cost-based attributes trade timeliness for reliability. Value-based attributes capture current economics at the cost of more judgment. When fair value is required, a SC 820 ranks inputs in 3 levels. Level 1 is quoted prices for identical assets in active markets, used without adjustment. Level 2 uses other observable inputs like yield curves. Level 3 relies on the entity's own unobservable assumptions and demands a reconciliation, disclosed technique and inputs, a sensitivity analysis, and manager approval. The less the market tells you, the more you must show. Fair value reflects the principal market, the one with greatest volume and activity, or the most advantageous market if none exists. Transaction costs are excluded from the measurement itself. And for non-financial assets, fair value assumes highest and best use, the use that maximizes value to market participants, which may differ from your actual use. Disclose when those uses differ. The framework produces real answers. Research and development is expensed under a SC 730 because measurability fails at the research stage, with a narrow exception for software after technological feasibility. A warranty creates a present obligation from a past sale, recognized when probable and estimable, and measured at the best estimate of future costs using historical claim rates, discounted if long-term. An asset retirement obligation is recognized when the asset is built, because the past event has occurred, even if payment is decades away, measured at present value. A contingent gain, by contrast, is not recognized until all contingencies resolve, only disclosed when realization is highly probable. That contrast is asymmetric prudence: liabilities when probable, gains only when certain. Since 2009, the ASC has been the single authoritative source of U.S. GAAP, absorbing all prior literature. Its structure runs topic, subtopic, section, paragraph, and the section codes mean the same thing in every topic: -15 scope, -20 definitions, -25 recognition, -50 disclosure. If a position is not in the ASC, it is not GAAP, except SEC guidance for public companies. Disciplined research beats ad hoc searching. Define the issue as one precise question, identify the relevant topics, then critically check scope and definitions before recognition, since that is where most errors hide. Read the implementation examples and the disclosures, then document the issue, citations, facts, conclusion, and reviewer. Escalate anything material, unusual, or uncertain. Sometimes the ASC simply does not address a transaction. A SC 105 gives the order, apply similar standards by analogy, then the conceptual framework, then non-authoritative sources, documenting your reasoning. Here the framework reconnects to daily practice, but silence is never a standalone conclusion. You must document your search, confirm the silence, and reason your way to a defensible answer. The international framework is broadly similar but differs in ways that matter. Most fundamentally, the IFRS framework directly underpins its standards and must be applied when IFRS is silent, while the U.S. framework is only a fallback. IFRS drops probable from the asset and liability definitions, treats income as a single element, and names substance over form explicitly. Measurement is where clients feel the differences. IFRS permits revaluing property, plant, and equipment to fair value, which U.S. GAAP prohibits. IFRS allows impairment reversals except for goodwill, while U.S. GAAP never does. IFRS also adds fulfillment value for liabilities. For any client reporting under both frameworks, maintain a formal reconciliation covering every difference that affects reported amounts. None of this works without controls. The team member prepares and escalates judgment calls. The team lead reviews all work and escalates material or unusual items, and the manager gives final sign-off on material conclusions. Non-routine decisions need a research memo, Level 3 measurements need manager approval, and scope exceptions must be documented affirmatively. A team member never finalizes a material judgment alone. Everything converges on the period-end checklist. Confirmed material transactions were tested against the SFAC 6-element definitions. All 4 recognition criteria were assessed, and each measurement attribute is documented. Complete the full Level 3 package, review materiality calls, update IFRS reconciliations, and obtain team lead and manager sign-off where required. The checklist is the entire framework, turned into action. Let's close. The whole framework flows from one objective, useful information for capital providers. From there, you classify an item against the element definitions, test it against the recognition criteria, and measure it with the prescribed attribute. When the rules go silent, the framework fills the gap, always documented, and controls turn these principles into reliable practice. You now hold the framework as a single, connected system. Thank you for completing the full FASB Conceptual Framework series.